Hi everyone, my name is Joe Cadlick, a Mergers and Acquisitions Partner in the Corporate and Securities Group at Troutman Pepper. I'm here today with Pat Below from Phoenix Management Services for a series of unscripted and impromptu interviews to discuss a few topics in the distressed M&A world. Pat, thanks for being here.
Yeah, thanks for having me.
Why don't you tell us a little bit about yourself and Phoenix Management?
Yeah, so I'm a director with Phoenix Management Services, and we advise, manage, and raise capital for transitioning businesses.
Pat, for this conversation today, when we're talking about the distressed M&A environment, we wanted to spend a little time on how we advise the buy side and how we get buyers who may or may not be familiar with the process ready to go to look at a company that's in a distressed environment. What is important for buyers to keep in mind if they're looking at a distressed business to acquire?
Again, it's really important to have strong advisors because none of these distressed processes come without risk. And so one of the important considerations is understanding how is this transaction going to be consummated? Because it's not going to be a stock sale. So is it going to be a bankruptcy, an Article 9 sale, assignment for the benefit of creditors? And what risks are you able to insulate yourself from because of that process? And what risk may still be there, but you're just comfortable with because you're getting a deal on the company.
Right, so can you flesh that out for me a little bit? I understand the legal side of why it may not be a stock deal, but what are the practical implications of why it wouldn't be?
Yeah, so by nature, in a distressed deal, right, there's not enough cash there to satisfy all of the liabilities, right? So if you think about the capital stack of the company, you have the senior secured lender, you may have senior notes, you may have mezz debt, preferred equity, common equity, and by nature, there's not enough money to pay off everybody. And so you have a fulcrum security in the middle, who's the most senior security that's not going to get paid off in full. And you need to be really in lockstep with who that security is and what their intentions might be. So from a buyer standpoint, you want to understand who they are, what their motivations are, so that you can try to elicit their cooperation in a sale. And it might be that you're having to offer more to get them higher recovery, or it might be that you're offering them something on the back end in terms of equity in the new venture or what have you.
So, okay, thanks. So what else should the buyers be thinking of practically to get this company ready for day +1 once the closing's happened?
And so this is something that sometimes gets overlooked in a distressed sale, right? Because the timelines are so compressed. And mostly with private equity groups or strategic buyers who aren't used to buying distressed companies, it's really hard to stand NewCo up on day one because it's not a stock sale where you're taking all the bank accounts and all the insurance and all the payroll providers over on day one. There's a very long list of things that need to get set up on day one, and typically people don't start early enough because there just isn't enough time. And the vendors that you're using for your bank, your payroll provider, your insurance provider, can't move as quickly as you need to, and it's really hard to set the company up on day one if you don't have bank accounts. And you can't get bank accounts until you have officers, and you can't have officers until you have insurance. You can't have insurance until you have entities. So when you're in a really compressed timeline, there's a really long list of things that need to get done, and that's why it's really important to have strong advisors like yourself or like Phoenix that understand what's the full list of things that need to get done, what are the interdependencies, and how do we put these things in place on day one so that the NewCo can hit the ground running.
So what we're often looking at on the legal side is, okay, we're getting this company set up, we're ready to go. And frankly, some of the companies we work with, they are tacking this onto an existing operation and perhaps don't have to do all of that, which aids on some efficiencies. But we are looking at a lot of unique things in diligence, right? And we may have buyers that are not familiar with this process. They're not always familiar with the particular legal risks that come, right? We're buying a business that may have outsized liability exposure, or injections of capital are required in a way that is not always needed for some of the targets that our sponsors or other buyers are interested in. So we're always looking at things like, okay, it's been a distressed environment for this business for a while. Who has been shorted for some period of time, right? Have employees been struggling for a while, not getting the bonuses they might be used to, and that needs to be taken into account post-close. Are there suppliers and vendors that invoices have been sitting around for a while? That's part of this strategic plan of getting this business up and running afterwards, if you need them, and integrating that into a full plan going forward. There's a lot of interesting ways we can try to elicit information on those types of things and the unique risks in a business like this. Although there are unique challenges, these aren't tricks of the trade or anything. These are the normal things we do in diligence, conversations with management, We always look at the loss run reports. There can be some very interesting things there about the business, and litigation searches, and all the usual diligence asks we make, just to make sure we're turning over every stone. And then maybe a question for you, Pat, is in terms of trying to really understand what was going on with the business, what kinds of things are we looking at to try to understand the fundamental problems? It's not always just the market economy, right? It's not always financial. Are there things about management or other situations that we're looking to try to figure out if we're ready to go and move forward with this company?
Yeah, it's a really good question because by nature the company is distressed, so there is a problem on the balance sheet. But you don't need just a restructuring person that's going to put more debt or inject more cash into the company, right? Because if you don't fix the underlying problems with the business, then you're just going to end up in the same situation. So we can be a really helpful resource for either strategic buyers or for financial buyers who are looking at distressed opportunities to help them realize when you merge these distressed assets onto your platform business, how do you make what's on the spreadsheet actually come to life, right? Everybody wants to take two revenue streams and put them on one cost structure. But how do you functionally do that? And who's the quarterback that's going to merge all these things together? And that's what we're really good at doing.
And we've talked in the past about helping sellers through this process, and sometimes the process can be very quick because they're maybe running low on cash. We always want to be careful with our buyers to not overplay that hand and overplay what leverage may come with it, because if you wait too long, maybe there's a low amount of cash, and we certainly don't want to create an asset that is not going to be relevant and not going to be something we can build on from there. So it's important to not overplay our hands in this deal process and managing the buyer. So it's always an interesting environment. These deals move quick, but that's what we're here for, to help people through it.
Yeah, absolutely.